In this video, we're going to talk about SNDL, Sundial Growers. So Sundial Growers has been an interesting stock to cover and for many people to trade. Of course, if people ask me, would I buy any SNDL? I would say that it depends where the stock price is and especially where the market is at the moment. So my portfolio is relatively diversified. So if I wanted, I could have bought a position in Sundial. But back in 2018 or 2019, when the stock first began trading, I wasn't present in the stock market, or any market for that matter. So I kind of missed that period of time. And in the retrospective, I could have gained some handsome profits if I were trading stocks back then. Of course, I also avoided some hefty losses as well if I started to trade at its peaks. And speaking of peaks, I would say that, and this is especially obvious for SNDL, another one I think has been reveiw, whereby those companies, as soon as they begin trading, the stock goes down. And this shows a certain mood of the market or a certain sentiment of the market towards those types of companies. I think that fundamentally people are willing to look at how things go, but very few of them are willing to make the jump. Or at least if there are, I don't think that they are in large scales. And what do I mean by large scales? I mean pension funds, institutional money, or mutual funds money. I think that for SNDL and companies that are similar to it, people have been aware that, this is going to be an interesting stock to look at. But I don't think that many people really have a lot of faith in exponential growth or handsome profits or a lot of dividends, right? So this is ultimately what we're aiming at when we talk about companies like SNDL or its entire sector. Fundamentally, it is a retail sector, or if you want, agricultural sector. It's not supposed to give you that much of an exponential growth other than regulatory aspects. So because of this, I think that from the get-go, this has characterized this market. Now, its valuations are sometimes similar to tech companies, but I would say that it's less generous and with less growth as well. So it's kind of like a small version of the tech sector, especially the tech sector in the heydays. So from 2010 to 2020, that kind of period of time, or even from 2020 to 2022, or the early part of 2022. In terms of the risks, I would say that SNDL is facing risks not necessarily from regulation aspects, but from the uncertainty of the regulations. Meaning, we know that the regulation will very slowly open up, but in the same time, is the market willing to wait for this to happen? Because those regulations might have released a valve for some markets, which have already been flooded by those companies, right? So could there be more new areas open? It's possible, but it depends on the public opinions of those countries. So this is where the uncertainty comes from. And also, the other aspect is about the company itself. Maybe not the sector, but the company. I have looked at the financials of SNDL, and to be frank, it's not that impressive. I would say that if we're looking at companies from a purely managerial aspect, there will be other companies that are better stewards of your capital. However, SNDL has kept people interested partially because it has demonstrated to us that whenever we think that it's gone flatline, it's going to jump back up again, whatever the reason, whatever the current environment. Very often, it's going to play on both tables, right? So first of all, recently they have purchased another company and they said that, okay, we're going to have more vertical integration. This is always a good story to tell, especially when you're in that kind of companies. where you're favoring growth instead of profitability, at least for the time being. Albeit, even for this kind of story, at some point, they would have to change the narrative because it's not going to last forever, right? The other thing is the overall environment itself is getting slow. It's like slowly recovering, I would say. What do I mean by slowly recovering? I'm not saying that things are necessarily getting better. They're just getting priced in. Or rather, they got priced in before. And now they're just getting back to like a new normal, which is a sort of baseline that is going to be higher than the previous bottoms, so to speak. Partially because there's more money, partially because there's more people trading to begin with. But of course, if this assumption is no longer true, then we would have to reevaluate things. So I remember back in the 2008 era, the oil price of the nearby gas stations, they literally halved overnight. Let's say they were $1 per gallon the night before. The next day, they were like 65 cents. So this means that because there's exponentially less people buying this product, and this has caused a price crash, I don't think that this is going to happen this time, simply because, one, there's more of us interested in stock markets, there's more money flowing around, and even if, like I said before, institutional money is not necessarily in the play at the moment, it doesn't mean that retailers have lost their faith in like growth companies or meme stocks per se, right? I don't think that this has really happened. Also, if I were to look at like where do we go from here, I would say that SNDL is a risky company, partially because of the sector, but also because of the company itself. And also because the market has already priced in the potential growth that it's going to have, not right now, not the present growth potentials, but including the future growth potentials as well. So it is because of that reason that I think that further growth would have to come from new narratives. Because I don't want to say that its fundamentals are going to improve significantly in like the short to medium term. I doubt that this is going to happen, right? But I think that they would need to come up with new narratives in order for SNDL to keep growing. And so far, I'm not seeing this, not yet at least. So for which kind of investors or traders is this company for? Risk takers, risk-tolerant traders who believe that the market will recover in the medium term and who are willing to surf on not the reality itself, but the expectation of future reality or the expectation of the projected reality a few years down the road. In other words, let's say everybody is selling their house at the moment, right? Would you be willing to buy a house now, knowing that everyone is selling? So this is what rich people would tell you to do, except they happen to know where the bottom is for the most part. Like, they may have more indications that the market has actually bottomed and they have entered, right? So is the bottom now? This is something that you would have to decide for yourself based on your own knowledge of how the economy works. And if so, when is the rebound going to happen? Personally, I think that the market will be tanking for some time still, simply because if you think about it, we've been having a wonderful bullish run over the past, I would say, 14 years or so, right? With some blips in between, such as the flash crash or whatever. But overall, things have risen steadily. And that doesn't necessarily have anything to do with the state of the real economy itself, just like our unemployment number may not necessarily reflect the number of people looking for activities, right? Because the way that it's calculated, so on and so forth. So the reason why those titles have increased so significantly has a lot to do with the quantitative easings or with the capital flights elsewhere in the world, because maybe in their hometown things are not so hot at the moment. So for those reasons, the stock has increased for that long. And we're going to talk about like the overall economic trends later in the video as well. But for now, in terms of my opinion on if the market has bottomed, I would say that it has shown its desire to go lower and also is actually taking a break at the moment. So it's going to, I think that it's going to keep going down over the next 12 to 24 months. Or if it doesn't nosedive, it's going to grind lower over the next 12 to 24 months. That's just the way a normal market should react or should have reacted a number of years ago. Now let's get back to SUNDIAL growers. So like I mentioned before, the type of investors who would be great for SUNDIAL growers are the risk takers and who are willing to surf on expectations of reality, not necessarily reality themselves. Is now a good time to buy? Like if you were that type of investors, is now a good time to buy? I would say this. The downside is certainly limited, right? Because how much lower can they get? But they could potentially get delisted from the public exchange and to be traded over the counter. This is a real possibility to be played with. And so from that perspective alone, I would say that yes, an entry can be considered now, but you do have to leave significant room for later purchases if it goes lower. So I think that given how little money is present in the company's equity at the moment, it means that everyone is selling their house. To go back to my image used previously. So everyone is dumping their positions. And because of this, it might be a good opportunity to start buying. Because when everyone starts buying, it's kind of late to join the gravy train, right? Sometimes it doesn't work. So like as soon as we jumped on a gravy train, the gravy ran out. This has happened more than once. So this is my view overall about SUNDIAL growers. Would I recommend you to buy it? Like I said before, if you correspond to that type of entrepreneurial, risk-tolerant traders, who also are kind of a little bit of a believers, to be honest, like you believe that SUNDIAL growers is going to do well in the next few years, then I would say that yes, but you have to make sure that you have a very diversified portfolio. So that even if this stock tanks, which is a material possibility at the moment, again, right? I'm not cursing it. I'm just saying that statistically speaking, there is a real possibility that this stock could cause you some losses. Your entire portfolio is not going to suffer because of it. So I would say maybe a maximum exposure of 3 to 5%. Actually, you know what? Let's keep it to 3. Of around 3%, I think would be a decent choice. And this is the overall allocation, mind you. It's not even like what you want to buy tomorrow. So over a period of time, I would say at least 6 to 9 months, just gradually dollar cost average in. And this, in my opinion, would be the best way to go if you want to buy SUNDIAL growers. Now, given the current market environment, I believe that the equity market is in a vast phase of correction, especially when it comes to tech and growth type equities. The financial market has been living and breathing thanks to the continuous creation of new capital with different waves of quantitative easings, which will have consequences on the price of assets as well as their yields. With the interest rates kept relatively low over the years and the increase of amount of capital in circulation, this will keep putting significant pressure on the profit that we can expect the investment products across the board. And this, by the way, is a reality that may shift in the years to come if the interest rate of core infrastructures within our globally financialized system increases. It's useful to remember that the market doesn't represent the real economy, and of course, the real economy doesn't always reflect in the stock performance, since the name of the game here is ultimately called supply and demand, which depends on a whole bunch of factors that go way beyond our own control. If we think about it, this is like saying, if your neighborhood house that is put up for sale is only allowing those who actually want to live inside to buy it, versus if you allow every single type of buyer with different intent or reasons to buy or to sell it. So obviously, there will be a significant difference in the price of this asset for those two scenarios. The market currently works more like the second option, and assuming that it would only reflect the fundamentals of the underlying economy would correspond to the first option. There are a few elements that are considered to be the reasons. The first one is the significant increase of amount of money printed by the central banks around the world, which is then distributed to the banks, with the expectation that they will be loaned to businesses. Normally that's a good thing, but with a lack of opportunities in the real economy, the significant portion of that money actually went back to the financial system to buy up the price of existing assets. Now that the QEs have been wrapping up or ended around the world, I think that this drive behind asset price may no longer be as relevant as it is right now for the future. It is now compensated by the arrival of capital from one region to another, and from one sector to another even within the same jurisdiction. With the increase of tensions around the world, capital is always looking for a safe haven to park their money into, not just for a place to grow the nominal value, but with a currency that tends to keep its purchasing power as well. The third factor is the creation or the birth of artificial bubbles, either maintained by the market trends built up over the years or out of necessity. Capital needs to find a place to stay. Some good examples of this would include the EV sector in the 2020 and the oil and gas securities when there are tensions around the world. Either way, when it comes to the price trends of the market, the degree of uncertainty is a key drive behind the price fluctuations, and that is likely going to increase as we go on from there. When companies announce that they are going to enter or exit different markets, or that they will be trading on different platforms and exchanges, this can all have significant ramifications on the price of this asset. Some of the considerations to have when operating in this context include having a clear view of what is going on, especially regarding the cash flow and the capital flow, and avoid certain potential pitfalls. One of these is to be careful with short positions. Inherently, short positions are riskier than long positions, as the downside of long positions is limited, whereas the short positions can lose you as much money as the stock price may reach, which is infinite. On top of that, we're now seeing a new phenomenon with short squeezes, involving a group of retail traders propping the stock price up, forcing short sellers to recover their positions. Sometimes the attempt will not succeed, but sometimes they end up in very spectacular success. Something else to consider is to treat tech stocks with care. To start, ask questions when the price of a security skyrockets without real fundamentals. It doesn't mean that you shouldn't be touching it with a 10-foot pole, but it does mean that there should be a difference between the decision of long-term holding and short-term trading. Either way, a rule of thumb is that each position should be structured in a way so that their individual performances will never affect the portfolio's stability. Thank you for watching. If you like my content, please like, comment, and subscribe to my channel.